Our next guest says that never before have stocks been so overvalued while gold is undervalued. Joining me today is Will Rhind, CEO of GraniteShares. Will, welcome back to the show.
Thank you, David. Great to be with you.
I want to talk about a very interesting strategy that you have for picking out the worst stocks, and I'll explain what that means at the end of the interview. But first, let's talk about your investment thesis. Why are stocks overvalued right now, Will?
Well, stocks are overvalued, I think, David, because we have a situation where we have, the largest amount of unemployment that we've seen, particularly here in the U.S., since the Great Depression, that continues to accelerate on a pretty incredible basis. We've seen vast amounts of the economy being laid waste by the coronavirus pandemic. Vast sections of industry being sidelined, going away that may never return. All at this time, we see stock prices return to almost at the highs we saw pre-pandemic, which is pretty incredible.
What we're seeing now is an interesting dichotomy between fear and greed in the markets. I think this is a very interesting time because we're seeing a lot of fear in the world overall, while at the same time a lot of greed in the marketplace. Can you explain why this is happening?
I'll try, David. It's a difficult one to explain because a lot of people look at the rise in the stock market and are confused by this information. But I think let's talk about some of the things that we know are fact. So, fiscal stimulus, that does lead to an increase in GDP. So government spending is going to impact GDP. And the more government spending, the more fiscal stimulus there is, that is going to have an impact of GDP. I think the other thing is that, people think about this playbook and they think about 2008. We saw, the largest financial crisis that we've seen, really for a long, long time. People thought that was a once in a lifetime event. And obviously now we're going through something similar, albeit much bigger magnitude. And remember, the lesson for equity investors back then was just to buy the market. And there was this concept of don't fight the Fed. The trend is your friend. The government's going to backstop the market, and therefore, printing money, et cetera, help drive the stock market high. And I think there's a lot of that's happening right now, that people are just thinking about that playbook of the last 10 years and just buying the market indiscriminately.
So let's talk about the metal side of your thesis now, gold. You're saying that gold is undervalued, even today at levels surpassing the $1,700 an ounce. Do you still think it has room to grow?
Yes, I do. I mean, for two kind of principal reasons. I mean, we can talk about gold for hours, but I think, one, let's think about the 1980 high for gold. And on an inflation-adjusted basis, that price today would sit somewhere around the $2,500 an ounce mark. So clearly, we're quite far away from that today in terms of breaching an inflation-adjusted all-time high. Now, the nominal all-time high was reached, as everybody knows, back in 2011, so a few years after the financial crisis, when gold got to over $1,900 an ounce. So even then, we're still not close, that close to the all-time high. So gold is still an asset that's trading below its all-time high. Contrast that to many other, better-known asset classes or well-known asset classes around the world that are trading at or near all-time highs. So I think from that basis, gold has still got a way to go here.
A lot of investors are wondering why silver isn't catching up to gold right now, because in the past we've seen silver outperform gold on many occasions when gold has been in a bull rally. Is it because the industrial demand is weighing it down, or lack thereof, should I say?
Yeah, I think it's a little bit of that. Certainly the market is quite well supplied from a silver perspective, but I think the main thing is that in terms of the safe haven sort of aspect of gold, silver just doesn't have quite the same properties these type of times. So I think all things being equal, if the gold price continues to rise, silver will almost certainly be able to rise with it, but it doesn't quite have that, that counter-cyclical property, the same counter-cyclical properties that gold have.
Yeah, I think the markets have agreed with you on the or undervalued aspect of gold, because last month in April we've seen record inflows in gold-backed ETFs. Will, can you explain this phenomenon?
Yeah, so the gold-backed ETFs, the last high we saw was actually in the 2012, 2013, so just a little bit after gold had made its all-time high, nominal all-time high. And so that took a number of years to be breached, and we got there again sort of in the last 6 months or so. And so now we've got an all-time high in terms of gold ETF holdings. So this is just holdings in gold ETFs around the world, which I think from a sentiment perspective, that's been climbing since the bottom, which was in 2015, 2016, in terms of holdings of ETFs. And it's been steadily growing since then, but it's obviously accelerated sort of coming into the beginning of this year. So investors are certainly positioning bullishly and anticipating higher gold prices purely on the back of this trend or this data.
Are we seeing the inflows coming mostly from institutional or retail investors? Will, do you have any data on that? Because we have seen a surge in brokerage accounts opened in the last few weeks to months, mainly from the retail side. Is that translating to the gold sector in any way?
Yeah, it is. Although you see the thing about an ETF, so our gold ETF, for example, the GraniteShares Gold Trust, bar, that's now, it's nearly $1 billion ETF. And because it's listed on the stock market, anybody can buy it. So you're going to get retail investors, you're going to get financial advisors, you're going to get institutions. So you get people from sort of all walks of life, so to speak. But certainly, the retail investor makes up a big part of the US ETF market more broadly. If you look at the total industry statistics, people think it's anywhere between sort of 30 to 50% of all participation in the market. So it's pretty sizable. But I think what you're referring to is, brokerage accounts such as Robinhood. There have been some well-publicized statistics of significant amount of accounts opened for people to trade the oil ETF, well-known oil ETF USO, for example, or trade some of the more popular tech stocks such as Tesla when they had its run over the last few months. So there's certainly anecdotal evidence that people are getting into the market, they're opening new accounts, they're trading these products. And I think part of that is due to the volatility, because when you get volatility in the market, you get opportunity. And I think a lot of people see there's an opportunity in certain sectors, whether it could be bombed out stocks that have been affected by the coronavirus, or it could be things like gold. And certainly we've seen a lot of interest in our gold ETF this year.
Let's talk about one of your newer funds, the ExOut, XOUT ETF. This is a very interesting strategy. So instead of picking the best stocks, you're going to pick the worst performers and take those out of a portfolio. Tell us more about how this works.
Yeah, that's right, David. It's a completely unique investment strategy. And I think it's our take on how to really tackle this idea of technological disruption in the world. So technological disruption, we believe, is one of the largest forward-facing risks faced by all investors. And so how do you think about tackling this? And really, there's been two approaches, kind of broadly speaking, in investment terms, over the last sort of 30 years. And that's been, on the one hand, you pick winners. So that's active management in its broadest construct. Everybody's geared to selecting the stocks that they think will outperform the market. Then on the other side, you've got the people that think, well, that's a load of nonsense. It's not possible to do that consistently over time. So we just buy the market. And that's what has led to this huge rise in passive investing in index funds. Our take is completely different. What we're saying is actually, we know that picking winners is really difficult, but it also doesn't make sense just to own every stock in an index, regardless of whether it's a good or a bad company. So why don't you focus on actually screening out those bad companies, screening out those stocks which are vulnerable to technological disruption and Xing them out of the portfolio. So the whole idea behind ExOut is we think it's more important what you leave out of your portfolio than what you put in. And that's based upon the huge amount of research that shows that the performance of the broad stock market is really driven just by a few stocks anyway. And people own those. They already have them in the portfolio. That's the Amazons, the Apples, the Facebooks, etc. So everyone owns those stocks already. So why don't you focus on the ones that are detracting from performance, those that are vulnerable to technological disruption, and leave them out.
So I'm just going to list out some of these stocks that you've picked to exclude in the ExOut strategy. Walmart, Visa, JP Morgan, Verizon, AT&T, Coca-Cola, Bank of America, Exxon, Chevron. What are these? These are, for first of all, they're all large cap, blue chip stocks. But aside from that, what else do they have in common?
Yeah, so we have a 7 fundamental metrics that we look at in terms of screening these stocks. We evaluate every company, large cap company in the market. So we take 500 largest by market cap. We score them based upon these 7 fundamental metrics. And then we exclude the 250 or half of them that get the lowest scores. And if you look at this basket, we call them the top 10 danger stocks. Just over the last quarter, for example, the data's just come out. We've rebalanced the index. But over the last quarter, those 10 stocks underperformed the market by almost 8%. And the quarter before, it was just over 5%. So it's a significant risk or underperformance to your portfolio. And they all have different things, different attributes which make them excluded. But if you take Walmart, that's the largest ExOut that we have currently. For one of the main reasons it gets penalized is it's just so big. So in an age of digital disruption, it's been hard for them to really grow sales in a meaningful way in order to affect growth and performance. So on a real basis, so after inflation, the sales are actually going backwards, and that's one of the big things which affects them. And obviously, if you contrast that to someone like an Amazon, who can really thrive in this environment, which is really almost like a digital company. Yeah. And then you have other stocks in there. You've got some financials, the JP Morgans, etc. Clearly, right now is a very bad time for banks with zero interest rates, so it's difficult for banks to make money. You have some large oil companies in there as well. Oil's been having a very difficult time. So again, it's difficult for them to grow revenue in an environment where oil prices have been dropping so significantly. So each company has its own story, but the commonality is these 7 fundamental metrics that score each company on an even basis.
Do you think this coronavirus pandemic has changed the way you as a fund manager has defined a laggard from a winner?
I think that if in many ways it's just accelerated it. So coming into this, we had this idea that actually maybe or potentially a better way to invest in the broad market was to focus on excluding losers, because we felt like that was an easier thing to identify a loser than to pick a winner. But actually what's happened is by focusing that lens on technological disruption, the pandemic has created this chasm now in the market between the haves and the have-nots. And so you see the haves, in terms of the companies that can thrive in this environment, thrive in an environment of technological disruption, of digital innovation. They're going from strength to strength. And even sort of more traditional businesses that have got their digital game going, like Target, for example, recently came out with earnings, is doing very well, partly because it's got its digital online game going. Then you've got companies, more traditional companies like Coca-Cola, which is one of our top 10 ExOuts as well, that although it's a brand that everybody knows and everybody's very familiar with, one of the problems in this coronavirus pandemic is it just shows the weakness of its physical distribution network. And so relying obviously on restaurants, on bars, on pubs, etc., so much to distribute, that has become a big issue and a liability. So I think what you're going to see is this chasm continue to open up between those that can thrive in a digital online environment or a disruption environment and those that can't.
Great. Excellent thoughts today, Will. Appreciate you being on the show with us.
Thanks, David. Always a pleasure. Great to see you.
Yes, and thank you for watching Kitco News. We'll have more for you, so stay tuned.